Okay, so a couple of things. Most of you know, I'm Zacc. I'm with Capita. I run the Financial Call podcast, do a lot of financial education. Matt Johns is one of the team members on the Capita Internal Investment Committee, very involved with investment analysis and understanding markets and economics. Kurt Brown is with Townsquare Capital. Townsquare Capital is our platform that we use for the most part for almost all of our investments, where his teams, as well as the teams that Townsquare hires, helps make the final decisions on exactly what stocks, bonds, or funds end up in your portfolios. Townsquare, we like what they do because they curate and basically provide a triage for the thousands of money managers that want people like Matt to put your money in. Townsquare does a good job of narrowing that down to fewer strategies that we like and that align with our belief set as well. A lot of that belief set, just as a quick refresher, has to do with not having portfolios that turn over too frequently and having either really well diversified at low cost or having it be somewhat concentrated to be different than the market. I paused there for a moment because somebody said the audio may be cutting in and out. Thank you for other people. I'd like to know if anybody else is experiencing the problem. It could be an internet connection on your end, but if it's not, if it's something broadly, I want to know so that we can try to fix it on our end. So today I have maybe one or two questions, and Kurt, I feel like you'll be able to drive some of the main conversations, and I'd love for you to be able to spend maybe at least 15 to 20 minutes without too many interruptions, because this conversation is different than maybe some of our other quarterly market updates. I feel like a lot more is happening right now than has happened around our last quarterly market updates. And so given that more has happened, and by the way, our attendees, our numbers go up when there's more volatility to these calls. So I can almost peg the amount of activity in the markets on how many people attend these quarterly calls. But I'd rather y'all sleep better at night and have less volatility. But anyway, so why don't we do this, Kurt? You spend 15, 20 minutes, maybe go through what you think is most important for all of our clients to hear and to understand. And then from there, we can take it down into certain directions. And I'll give you that head start. And I did have a question come in prior to this call, and I want to just address it really quickly because I don't think we'll talk about it much more. And so I think we just knock it out and move on. I did get the question that's in the Q&A right now. So a couple of housekeeping. I actually love it when you put the questions in the official Q&A in the Zoom functionality. It makes it easy for all the panelists to see them. It also makes it easy for us to check off that we got them. Sometimes when they come in through the chat, it can be really difficult to ensure that we actually answered your questions. So I do have one in there. We'll get to that. Absolutely, there's been a theme around growth investments, so we'll talk about what's going on there. Okay, the question that came in prior to this event was about cryptocurrency, and the question was, are our advisors knowledgeable and able to give advice and understanding cryptocurrency, and what do we do with this? I would tell you that the actual question is, what is Capita's stance on cryptocurrency? Are your advisors trained in this new asset class? We do an enormous amount of research on crypto assets in general. And most all of the advisors are buying and selling and transacting in various currencies, NFTs, and other investments. That doesn't tell you much yet, because most of the advisors take small amounts of money and throw it at everything just to test it out. So if something goes wrong, we're not putting client money in it first. Does that make sense? Like, we are the guinea pigs for you. So we need and feel like we need to be aware of all new asset classes. So we try to play guinea pig for you. When it comes to this asset class in particular, as much as the concept is to create a frictionless transaction with less third parties involved, the more resources that become available to be able to transact in the space, the more middlemen are showing up and making money. And so it's not as frictionless as it is proposed to be for the average person. And also the volatility in it is so high that it's hard to justify making a whole lot of recommendations just yet to our clients about what to buy, what to sell, and how to hold and transact in this space. We've even researched platforms where they've set them up for advisors to be able to buy crypto assets on behalf of our clients. I didn't love the cost structure and the lack of, the risk is so high right now. Don't get me wrong, I have 4 different cryptocurrencies and a couple NFTs, but it's all like we talked about betting earlier, joking around, Matt, before Kurt came on.
Sure.
This is the way I view all of it. So hopefully that answers your question. I think there's a lot of really interesting things happening in the space from the technology that's coming from blockchain technology. I think there are a lot of interesting applications for smart contracts. I'm not yet, and this is maybe my personal, that's something else we should be aware of here. This isn't like Capita's official stance. We don't necessarily have one yet. We're in the research phase.
Well, and Zach, I'm going to chime in, and Kurt's going to talk about this because I think questions will come in on this just about what's going on with various portfolios that people have money into. Is there's different ways to invest. One of them is speculation. The other is to invest. Oftentimes our stance as advisors is we prefer to invest. And normally do that, we like to invest in something that's tangible and has assets, and something we can point to that has a store of value that we can reference and look at. The reason I say crypto would be more speculation is because it doesn't have that. It's an unproven. So it creates a high level of volatility because there's no store of value you can point to it. So different ways to do it. We're normally driven towards trying to find investments and not speculation, but we do have clients that get interested in that area. And so I'd just say one-off, talk to advisor.
Okay, let's do this here. Kurt, you dive in. I'm going to go on mute. I'm going to try to create those polls. So you talk for 15, 20 minutes. We'll poll everybody, then we'll tackle questions. Sound okay?
Hey, that sounds great. By the way, on the crypto thing, and Zach, can you let me share my screen? Would you permission me there? I'll add one thing on that. I worked on the floor of the New York Stock Exchange through the early and late 90s. I spent most of that decade down there on the floor. And I look at blockchain similar to the internet. The early, we take it for granted now, but there were a lot of losers in internet. And there was a tremendous amount of capital wiped out from the 90s in the internet. So you have to kind of go with kid gloves, even if you know the future of something is bright, because it's hard, to Matt's point, to know exactly where to put your money. So what we kind of do is say, hey, be careful, start smaller. If you're right, it's going to grow a lot anyways. Be diversified. And the vast majority of money that we manage is money that needs to grow, but more importantly, we can't lose it. And so a lot of the money that we're managing to that end. We don't do a lot of investments that are really highly speculative because it's your retirement money you've worked really hard for, so I'll just add my 2 cents on that as well. Okay. I'm going to talk fast. There's a lot of really important things going on. So let's rip through what we think are some of the most kind of critical issues. Matt, you can see my screen okay there? We're good? Okay. So we it's no secret what issues we're fighting here. We're fighting bad inflation. It replaced good inflation. Great economies have some inflation. We now have bad inflation, right? The real question, everything right now comes down to, is to tame the inflation, do we have to put the economy in recession? We may have to. Now, there's 2 types of recessions, right? There's really deep, bad recessions where lots of people are losing their job. Companies are vaporizing and things like that. But technically, a recession is simply just year over year, the economy slowed down from where it was before. It's in theory shrinking, right? We probably will see some sort of mild recession. We even saw a negative GDP number this week. So the question really is probably more about depth. You almost have to slow down the economy enough if you're going to tame inflation, right? I'm going to show you some things in a minute. Where we're at on this. I do not think a deep recession is coming. I'll show you why. Is Putin going to get really desperate? This risk is dropping. We were much more worried about this 6 or 8 weeks ago. It looks like the Russians are having a really difficult time. The Ukrainians are putting it to them. It's a great thing. We need to get that thing over with. Commodities disruptions, we're trying to absorb that. How bad is it? If this thing in Ukraine is wrapping up soon, that's going to help crude and natural gas a lot, probably, and wheat and fertilizer as well. And then ultimately, how does this all impact earnings? Earnings are the real deal. I saw some people in here asking about Poland and some other growth managers. You know, the growth managers have come off this decade of unbelievable returns, right? So they're giving some of that return back right now, because if we have to push our economy into a recession, right, usually the growth companies are hit the worst because they're more expensive. The really deep value companies aren't growing anyways, but the stocks were cheaper, right? So let's kind of dive in. How you know, this is really interesting. This is all data as of last night.
Hey, Kurt, I don't mean to interrupt
go
you,
ahead.
but like, I'm done with those questions. Would you rather pull them before you influence them?
Yeah.
Or would you rather? Okay. So
Let's do it.
Okay. So I'm launching the first question. Hopefully you guys can see that. So help me know, Matt or others, how does that view?
Looks good. I was going to say, as you guys look at the S&P 500 right now, I'm looking at it. It's 4162.
Good context. Yeah.
So context there on question number one is just knowing that, you know, right now it sits in the range of that third one down.
So you should have a pop-up screen that comes up on your screen right now. And I'm not seeing answers yet. Okay, their answers are starting to come through. So you should be able to guess. So do you think the market will be below 3,750? This is the S&P 500. Matt, you said it's at 41 what?
4162.
Okay, so we're in 4162. So we're currently in that middle, that 4,000 to 4,250 range. Where do you think we will end by December 31st, 2022? And then the second question is, will we have a recession within the next 12 months or not? And, you know, if there's spelling errors or grammar errors in there, you know, this is,
Please just email those to Zacc.
Email all your criticism my way. I can handle it. I'll cry later tonight, but I can handle it right now.
I'm disappointed because this says that panelists and hosts of the Zoom can vote. So I'm feeling.
I tried the same thing.
I know.
No,
my vote doesn't even matter. Like,
I could kick you out for a minute, but that's not gonna work.
I'm going to vote in just a sec with my slides.
Okay. So, and maybe write down what your answer is, but I'm interested. I'm going to save these, by the way, because we should pull this back up at the end of the year and see who was right. But okay, so last question is, how much will the Fed need to raise rates in the next 12 months? And I did 0.5%, 1%, 1.5%, 2, 3, 4. I'm going to give you guys we've been doing it for about 2 minutes, maybe just one more minute. I think most people have responded. We're still getting a few more. All right. I think we call it good. We don't need that much longer. Last chance here. I'm going to share the results. All right. Tell me what you guys see here. Can you see this?
Yeah, we can see it.
Okay. So where will the S&P be by the end of the year? 31% said between 3,750 and 4,000. And then 20% said where we are approximately now. And 24% said a little bit above. This is like a true bell curve according to where we are right now.
It really is.
Isn't that interesting? I probably should have given another option even lower, but yeah, that turned out really interesting here. Okay, so then the second question is, will we have a recession within the next 12 months? 81% said yes. It's interesting. And obviously that varies based on like the severity of a recession. I mean, recession is 2 quarters of negative GDP growth, right? So that can happen and be flipped around quickly. Last question, how much will the Fed need to raise rates within the next 12 months? And 29% said 1.5%, 26% said 2%, and then 24% at 1%. So Kurt, as you talk, it would be really interesting to know, like, what does that mean? Like, if the Fed raises by 1, 1.5, 2, how does that impact economies? How does a recession impact our markets? And then we understand what this means. But yeah, that was interesting. Thanks for the idea.
Yeah, that was super interesting. And, you know, I don't know if I'm in the smart crowd or not, but I think you have smart clients, and I agree with your clients. So that's actually, let's go through a few of these things right here. If you are not liking the performance of your retirement plan, I want to show you something here. You're not alone. Get this. The average stock in the United States right now is down 32% from its high. And the average large cap stock is down 27% from its high. Now, the S&P is the darling. It's only down 13% because it holds a lot of those really big blue chip, deep value kind of companies, right? That really didn't do very well the last 10 years, but are holding their value much better in the last 6 to 12 months. You know, things like Berkshire Hathaway and people like that, right? The NASDAQ, where all those growth stocks are down 20% so far this year. Look at this. 22% of those stocks are down 75% or more from the high. Here's what's really making this difficult. Treasuries, long bonds are down 21% this year. Treasuries, right? This is supposed to be your bedrock stable investment. Even high grade, this is high grade corporate bonds are down 15. Even muni bonds, which are historically one of the most stable investments you can possibly own, are down 9%, right? And it's the first time on record that both the US stock market and the US bond market have dropped more than 10% at the same time. Okay, so that's the kind of thing we've seen in the past several weeks. Okay, but one of the silver linings of what's happening in terms of finding a bottom, so to speak, is that investors are feeling incredibly bearish. And as none of you will be surprised, that's actually typically good news going forward. So we're looking right now at the third worst sentiment reading in 35 years. And the other two were at major market lows, right? March of 2009 was the bottom of the financial crisis to the week. And then the November 1990 bear market. And people are putting their money where their mouth is. $20 billion has flowed out of stocks in the last 2 weeks. The only time that's ever happened back-to-back weeks was in October of 2008 when Lehman Brothers and Bear Stearns blew up and it looked like the banking system was ending. So I bring that up actually for the opposite reason of why you might think, is that much damage has already been done. Now, I'm not saying the market can't go lower. We've seen in historical cycles in the 70s and the 80s when inflation was high, it took a little while to get the stock market turned around. We saw the same thing in 2001 when we were working off the excesses of that insane .com boom. It took several months to sort of build a real bottom. Keep in mind, though, one thing that's been happening in our economy that's very different than those cycles is that we have really been in the middle of an impressive, almost unparalleled expansion. And I'll show you a little bit of that in a minute as well. Let me tick off a couple other bad things, Zach and Matt. So in terms of the interest rate hikes we kind of asked you to vote on, we've actually officially only done 1/4 point rate hike, right? That was in March. Okay, but the bond futures market is already trading as if there's another 3¼ full points in it. And every 1/4 point rate hike we call generically a rate hike, right? So that's, what is that? 13 rate hikes are priced in already.
Only 14% of us here today voted that it would be that bad.
That's right. That's right.
So I'm going to just add context to this too. When most people think about rate hikes, I think they immediately just go to like, what's a 30-year mortgage? Because that's like I think that's what most of average consumers, like that's what most investors would think of. But this is the overnight rate that the Federal Reserve is lending to the banks. And it becomes a basis by which the banks determine how to set all the different loans. And you can kind of get what the market's thinking is going to happen by how much they move. I've also been making a point here, Kurt, when I talk about this. This has happened 4 separate times in the history of the US where they've raised interest rates like this since like 1990. Each time they've done that, the market has corrected 8 to 13%.
Yep.
So we're a little above that from the time they first do the rate hike, but we've been kind of in the realm of what the market historically has done when the Fed starts to do these types of actions.
Right.
Just in context.
Well, and your point, Matt, is spot on about the mortgage market to prove to you that the rate hikes are already built in, right? The Fed's only raised a 1/4 point. And when we say that, what we're talking about is the rate that they lend money to banks overnight, called the Fed funds rate. That's how they control interest rates, right? Well, it's only a 1/4 point, but look what mortgages have done. Mortgages since December 27th have moved from 2.65 to, so even the mortgage market has put about 2.5% already built in. So anything short of this is going to come back the other direction towards us. So if the Fed doesn't have to hike 10 to 15 times, we've actually overpriced already the rate hikes. So that's an important distinction. I keep hearing people on Twitter and places like that say, my gosh, look at the stress caused by just a 1/4 point hike. No, there's actually 3.25 more already built into the bond market. So a couple other things that have really been a problem is that we're seeing these labor shortages. Nobody, we've talked about this in the past. This is a problem. We've got to work this off. We're finally seeing some relief here a little bit. We're starting to have people come out of, quote, retirement from their stimulus retirement, or people that are over 60. Gas prices, obviously, as a result of Ukraine. This is one that's going to get more attention here, is wheat. About 1/3 of the world's wheat exports come out of Russia and Ukraine. So not only do we have a humanitarian disaster on our hands because of what Russia's doing, but now if this goes on for 6 more months, we're going to have serious food riots in these countries. You can see Somalia, for example, has 100% of their wheat is provided by Ukraine and Russia. So you're looking at some countries throughout Africa that are going to be in a world of hurt. So there's a lot of ramifications here. You've seen what fertilizer prices have done, right? It already was going vertical, and then the war really put this thing into overdrive. So that, of course, is another bad thing we're kind of trying to digest as investors. One of the biggest is that earnings are not going to be what we thought they were going to be. Now, you've had at this point about 2/3 of all S&P 500 companies tell us they're going to make less money. Okay, we know that. So far, it's not a lot less is what's been being built into expectations. Okay, and the next quarter, it's about a 2 to 3% drop in earnings expectations in the second quarter of this year. So that's not big, especially when I show you in a minute how much earnings have grown. So we're really essentially at this point coming off boil is what we're doing. We're not really talking about deep recession kind of numbers. Another thing that got alarming, Zacc, you and I have talked about this on prior calls, probably for close to a year, has been that the market, the S&P 500, got kind of top heavy. The top 10 stocks became almost 1/3 of the S&P 500, which means the other 490 companies were only 69% of the S&P 500, right? Even the top 5 are up to 23%. Okay, one of the reasons it's a problem, and everybody on this call has noticed, what's blown up since January 1st? Facebook blew up, right? We saw a meltdown in Netflix, right? We saw Amazon last week. Okay, here's why. Those stocks, those top 10 big stocks, that's 31% of the market. But look at what their earnings contribution has been doing. They're not 31% of the earnings of the market, right? Which means what? It means that the top 10 stocks were much more expensive. A massive premium was built into those companies because they have been so dominant for so long. But look at this now, right? The top 10 stocks trading at 31 times earnings, but the rest of the S&P is actually really honestly at about the 20-year average. So the market's actually by and large gotten a lot cheaper. And these big darling companies really have been the last to topple. I'm going to show you a little bit more data on that in a second. One of the reasons there's 2 reasons I want to bring this up to everybody today. One is you have to be careful falling in love with the darlings of the market. Now, there's no argument that these are truly some of the best companies in the world. The earnings and the earnings growth, second to none. Market penetration, by every metric, these companies are unbelievable. However, any investment can be too expensive, right? I just showed you that on the last slide. Okay, the last time we saw this happen was in 2000. The market really fell in love with a handful of companies. And we saw investors literally fire their financial advisors, pull their money out, open an E-Trade account, and just buy the 5 or 10 darlings of the market. I remember in 2000, this happened all the time. And everybody just thought, I'll buy these 5 or 10 companies and I'll put them away forever. Well, look at this on the right. If you look at those 5 companies now, 3 of them, the stock price literally never got back to the 2000 level. And Cisco and Intel have still continued to put up massive growth. These are not failing companies, but 22 years later, the stocks are still underwater. So it's a cautionary tale about don't get too enamored with any 1 or 2 companies. And I see a lot of portfolios now where people show me, hey, a third of my account is Tesla, a third of my account is Netflix, or whatever it might be. You know, you can make a lot of money, but you can lose a lot of money in that way. The second reason I wanted to bring this up is because the S&P 500 has not had very many times in its history where it's been so connected to so few companies. It was just a few years ago that the top 5 companies were only 11% of the S&P 500. So be careful when you're reviewing the performance of your retirement plan, because you probably actually don't want your retirement plan to just be the S&P 500. So I just want to put that on everybody's radar. Okay, let's tick off a couple of really good things that are still happening. Earnings are still unbelievable. I showed you that they're being revised a little bit lower, but we are coming off an unbelievable period of US history in growing the earnings of our companies in this country. About 900% in 13 years. It's almost unprecedented. Even margins, even with inflation, even with wages going up, our corporations are the best in the world. Just mathematically they are, and have created tremendous wealth and really an insane amount of free cash flow and earnings. In fact, Microsoft and Apple, if you just take the money that those 2 companies have in the bank, it's larger than the GDP of every country in the world except the top 7. So just their cash, not their sales, just the cash that they have in the bank. So these companies have really been impressive. Here's kind of another way of looking at this, what profits have done going back to the 50s. Look at that recent leg up in the last couple of years. Even as a percentage of our economy, we're making a new high. So it's when people berate the stock market like, oh, it got really expensive and it's disconnected from reality, that's just not true. The reality has been that these corporations have been creating true wealth in terms of profit, not just market cap, not just in shares. One of the reasons we obsess so much about earnings is this chart on the right. This goes back to World War II. It shows the relationship between what companies earn and what the stock prices are. You can see that barring a few weird windows of time where there's a little bit of disconnect, by and large, you go back 70 plus years and the relationship is almost 1-to-1. So when you're investing in companies, and sometimes they're public, like in the stock market, or sometimes you might be investing in private companies, you really are investing in the future earnings power of those companies. And so you can see on this chart on the left what's been happening on an annual basis to the 500 largest companies in this country. They really genuinely have created this wealth. So it hasn't been on air. In 2000, 2001, we didn't see nearly that kind of earnings acceleration, and stocks were trading at much, much higher valuations. So when people make the comparison to 2000, it's a little bit different. There's actually a lot more real money being created today. One thing that doesn't get nearly enough attention is I think one of the most important things in our economy is what a great position households are in. So let me give you a couple data points here. Since before the financial crisis, the average household in this country has more than doubled their net worth. That's a big, big move in 13 years, 14 years. At the same time, our usage of debt has gone down and actually gone down by a lot. So the percentage of income that you and I are spending on debt is quite a bit lower, and it's at a low since the data's ever been recorded. Even in the 80s, it was not the same. Another way of looking at that is how much of your balance sheet are you exposing to debt, right? How much leverage are you using compared to what you're worth? We all know that prior to the financial crisis, people were borrowing money like crazy and really speculating with that money, trying to flip multiple homes at the same time and whatnot. Well, that is completely reversed. So this is not a 2008 environment, right? We are talking about 50-year lows and how debt people are utilizing.
I was going to say, Kurt, this chart up here on the left is so fascinating as people start to think Q4 of 07 was leading into 2008 to 2009, which was a great financial crisis. So you look at the behavior change that took place when we experienced as a country of financial hardship. It kind of goes to everybody at home starts to get a little smarter. Same thing you saw here in 2020 on Q4 2021. Big decrease that transpired as to where we currently are is because of COVID.
That's right.
We have these big events that take place, and it changes our behavior. And part of it we think is just isolated to just us, but the data shows it's not just us. It's the country as a collective whole is being better with their money, and that leads more money to where it could be invested.
And it's really a credit to all of you that are on this call. We have literally thousands of clients across the country, and we see your balance sheets, and your responsible use of credit is dramatically improved from what it was in 07 and 08. And the point is that our economy is much better positioned to weather some kind of stress, like a recession that we could have in the next year or two, right? That's a really good thing. Most of our clients are not trying to borrow everything they can. And what's so interesting about it, Matt, is that people were borrowing in 05 through 07 at much higher interest rates than the last 3 years. Borrowing money has cost almost nothing, and people still don't want to borrow money because they were burned so bad by the financial crisis. Another thing that's shocking is the amount of cash that we are holding at a household level. I'm not talking corporations and the government. I am talking you. It is really stunning to see this. Okay, so let's go back a little bit. In 08, people had no cash. People were not holding any cash, and that's one of the reasons that 08 was so scary. Was there was no liquidity to buy anything. The system was falling apart, and there was no cash. Right. So coming out of the financial crisis, we started building up cash in a way that we had not in a very long time in this country. We started getting a little bit complacent, and then COVID hit. And now look at what's going on. We have never, as Americans, since the data has been recorded, since the Great Depression, have we held so much cash in our checking accounts as a percentage of our economy. Another way of looking at what's going on, we keep our eye on, is watching the earnings or watching what the banks are doing. So in the fourth quarter, for example, the two biggest lenders in the United States increased their loans, right? JP Morgan, 6%, Wells Fargo, 4%. So they increased their loans, right? That's what they do. They loan money. But look at how much came back in. For every dollar they loaned out, $3 came back in just to park itself in savings and checking accounts, right? So the banks can't give the money away. It's really a stunning development. Look at this. Since COVID, JP Morgan's deposits have exploded, right? $1 trillion, and they've barely lent anything else out. When I talk to our banking relationships, they just tell us, look, other than subprime, other than the really, junky borrowers, people just don't want to borrow the money. That is, Matt, to your point, that's a real behavior change.
Well, the part that's interesting with that too, Kurt, to the point, they try to look at like how much does it cost to borrow? And the cost to borrow with inflation is actually negative right now. It's still, even though rates are going up, it's companies are incentivized and individuals are incentivized to take more money out on loans, but the behavior is not following it.
That's right.
Because because as a collective whole acting more conservatively, which is a good thing in this and not a perpetual bad thing.
It's an excellent thing, and our economy is really prepared to weather a stall here. And we're coming off such an unbelievable blistering window of time. And I'll show you this in a minute, we need our economy to cool off a little bit. One other thing that's good, and our economy needs this, is we're going to finally get some relief in housing. These are housing units under construction right now. We're at a 50-year high in that category. We see building permits ramping pretty aggressively. We also see homes that have been authorized but not yet started making a 50-year high as well. So, a year or two from now, we're going to see a lot more supply in houses coming online. We need that. We need a market that is more orderly. There just has not been enough supply, and it's pricing too many Americans out of the market. This is going to be a welcome relief for a lot of our economy. Okay, there's only been 3 times in my 30 years in doing this that I've wanted the economy to slow down a little bit. We're in one of them, and it's happening. And this is where I'm going to share some thoughts with you that are really going to depart from what you're being told on the evening news. Right now, everything on the evening news is looking in the rearview mirror. You're looking at inflation data from January, February, and March. Okay, that's old news. In the last 6 to 8 weeks, things have dramatically changed, and we needed it. It's a cooling we wanted. So let me give you a few of them, okay? And this is real-time data, okay? So manufacturing orders, right? You're going to see it there first. If retailers have a bunch of inventory, they're going to not order as much, right? We're at 08 levels for manufacturing orders, and this is why. Look at the inventory levels for most retailers in this country. By the way, we removed vehicles from this because vehicles are in their whole own world right now. But in every other type of retail, we went from not having any inventory coming out of COVID to having a lot of inventory. So that is a normal, organic way to start slowing down your economy, right? Look at used cars. We just saw the biggest 2-month drop ever in the prices of used cars. And man, did we need it, because coming out of COVID, this thing has exploded because it was so difficult to get every single part you need for a car to get it off the manufacturing line, right? So we were really running a shortage of cars and trucks in this country. We badly, badly need this help right here, but it's happening, and literally just in 8 weeks, it's happening, right?
Well, and Kurt, you're talking about, so going back, inflation is something they quote on the nightly news all the time. When we look at this chart, everybody just kind of take an earmark note. If you were to remove used cars and new vehicles from consumer price index, one of the ways that they measure inflation, it would drop it by nearly 2%. Yeah. Now, it still puts us above what the 30 or 40-year average would be for inflation. It still put us in an area of like we're still experiencing some inflation in the system. But to Kurt's point, these cars resolving themselves could bring the inflation down 2% just on their own, not including the other supply chain slowdowns that we might experience because of overproducing goods like you just showed.
You're exactly right. In the last set of inflation data, Matt, a full 25 to 28% of all of the inflation increase was just because of cars.
Which is incredible. Like, that's staggering when people look at it, and you have some energy cost in there, but that's substantial.
Yeah.
And you hear it on the news, and the news doesn't go, oh, it's just driven by this. The news is like, everybody should start to be a little worried.
Right.
Because they don't speculate or dive into it.
Yeah, that's right. And remember, the inflation data is just measuring year over year. So inflation started running ahead last year. So as the year goes on this year, we're going to see inflation drop a lot, most likely, because it was already hot last year. And even if it stays the same, there's no increase in inflation, right? If prices stay the same. So you're going to see some easing of this data as the year goes on. Here's another one quickly changing. We started the year with an all-time most expensive to move things in a truck inside the United States. Okay, just getting a truck to go from A to B. We started the year at an all-time high, and we are quickly collapsing back under even 2018 levels. That's a big deal. This is real time. We are seeing the economy slow down without the Fed even doing a lot of raising yet. The bond market has priced it in, right? But we're actually seeing the economy slow, which is a really good thing. If you want to get a container from China to New York City, prices are down 50%, 20,000 to 10,000 in just 90 days. Okay, huge jump in mortgage rates, right? Look how quickly mortgages moved up out of this stable spot, right? In just several weeks. We kind of touched on that already, but look what that's done. Here's mortgage applications. We are back down at near the decade low for the number of mortgages being applied for on a weekly basis, and almost 70% now off the high from a year ago. Okay, so think about that. Combine all of the new houses coming online with mortgage rates jumping way up. So what you can see is in the period of, we know there's a lot of inflation, but just in the period of 6 or 8 weeks, many of the inputs in inflation are quickly cooling off. And this is why we don't think the Fed's going to have to raise 15 times this year. A couple of the things you might find interesting, and this is important, I touched on this at the top, is you might see that the S&P is down 13, and as of yesterday morning, it was down 15. It's moving around here, but the really important thing is that the average stock is down about 32% from its high. I touched on this at the top. That's important because a lot of the damage has already been done. We had a market that was not only too expensive, but there was a lot of garbage trading. Think companies that have very little value, junky kind of companies that were red hot in 2021. They've been taken to the woodshed in 2022. Actually, that is a good thing. Unless you personally loaded up on that stuff, that's a very, very good thing. So you don't want a market to get so hot that it collapses back on itself like we've seen at times in China and places like that. So yes, it's always painful when the market goes down in the short term, but in the longer term perspective, it's actually much healthier for our capital markets to get rid of the dead wood. It's literally like a forest, right? Like if too much dead wood builds up, the fire burns the whole thing down.
Well, in going back there, Kurt, I think this is interesting because a lot of people would say, what's going on with my portfolio? Why am I not doing well? This data right here in front of us really dictates a lot of it, is because I don't think people would look at what the S&P 500's done over the last year and they'd be like, market's doing fairly good, on a rolling 12 months in the S&P 500 because of the value names and having energy stocks. But what we don't realize is the NASDAQ down 22%. That's a bear market. Once you're over 20%, it no longer is a bull market. You're now in a bear market. Russell 3032, that's going to be more of your small cap looking at, and then the large cap Russell 1000, 27%. Like this is a big reason of what we're seeing, and that's kind of the anomaly. Is we're seeing bonds have done negative year to date. We're seeing almost all of the stocks have done negative year to date, minus the S&P 500, not as much, but it's still down to your very first slide you talked about. I just think this is very telling, where most people don't realize that top number year to date, S&P down 13. It's weathered it better. So
let me close with a couple of positive things, Zach, and then maybe we can take some questions. So I know some people see certain money managers they have in their portfolio that might be down 15% or 20% or whatever. But there's a lot of the market. If you look at the low profit margin companies as a group, they're down 60%, right? This is why we're always obsessing about owning really high quality assets. The market's gotten a lot cheaper. That's very good. We're back in here at the 10-year average of how expensive the S&P 500 is. Look where we came from. So not only did the market come down, earnings went up. So the market as a whole is actually getting cheaper quickly. We really needed this. That's a very good thing. Small cap stocks in the last 40 years have not been this cheap. That's a whole nother thing we could spend a bunch of time on, but that's a good thing. That's setting us up for kind of another bull market in the out years. Look at this in terms of right now. I kind of started at the top with how bearish sentiment is. And right now, only 16% of people that answer the survey say they're bullish on the stock market. It's a very, very low number. Well, the last 31 times that's happened, the market went up the next year 30 times by a lot. So we are in a window by an average of 20% in 12 months with only literally one exception. So we are entering a window here that normally is a time to sharpen your pencil and do some investing. I want to show you one other thing here is that people tend to think it's always bad for stocks when the Fed is raising rates. That is not true. Actually, the experience has been the opposite. Stocks have been positive during those times. And in fact, when the Fed raised from 6 to 21%, stocks went up 35%. Because you got to remember, the Fed's raising because the economy is so good. So yes, the market is volatile, and we're all trying to price this in and reassess the fundamentals of our economy, but it's against a backdrop of a very, very strong market. So Zacc, I'll throw it back to you, man.
You're good. That sounds great. Let me throw out one thought here, and then I'm going to jump into questions. So the thought is this: you can be completely right about something like, Kurt talked about bonds earlier. Bonds are down. A lot of the most conservative bonds are down 8 or 9%. And you might very logically think interest rates are going to go up, therefore my bonds should go down. You could have that very logical understanding of that inverse relationship that exists, and you could actually be completely wrong about the next 12 months for bonds. Because if you're not guessing whether or not you're right about that relationship, you're guessing whether the public is guessing right about that relationship. So in other words, what we're saying is the public has already priced in that 8 to 12% drop on a lot of different bonds is anticipating 3.5% increases on Fed hikes, basically. So if that doesn't happen, bonds could actually go up in value. If it happens at a greater amount than that, bonds could go down further in value. So your baseline is what the market has already priced in, and then you have to guess whether or not the market has priced it in accurately. And depending on which way you think the market is right or wrong, that's the direction of that investment move. Same thing with stocks. Has the market accurately priced in the company's ability to make money in the future? If the market has priced it right, and then it'll be exactly what the market priced it already. But anyway, I'm hoping to just help I see way too many investors get the educational or the conceptual part of the market right, and then they lose money because they didn't realize they're not actually just trying to get the concept. They're trying to guess whether the world got the concept and bet right. So let's talk about some of these questions. I do think the question about, what has happened to Poland, I'm just going to maybe come back to some of your earlier slides around earnings. Now, you mentioned that, some of the slide you showed where some of the stocks might be down 20%. I mean, what Kurt's talking about there is really some of the highest quality stocks are down 20. The lower quality stocks are down 60. So
let me put that back up there. I breezed over that, but this has been my whole life. Like this is honestly, what I do for a living is, and I showed this for the exact reason, Zacc, that you're bringing up. If you look at the 3,000 largest stocks, and by the way, that's the vast majority of the U.S. stock market. If you look at the Russell 3000 and you break it into 5 buckets with the lowest profit margin companies and the highest profit margin companies here, you see something really interesting. From the 1-year high of the stocks, right, over the past 12 months, the low profit margin companies have been murdered. You've heard me talk about the zombie companies before. They are in this bucket. They're here too, right? And so what you'll notice is that these high profit margin companies that have really big barriers to entry, the Visas and MasterCards of the world, they're down as a group, 15 to 20%. And that's the bulletproof companies. And remember what I said earlier, the average stock right now is down 35% on the year. So that's why we obsess so much about buying companies that are up on this end of the spectrum. Zacc, I probably stole what you were going to say.
No, that's it. That's perfect. I'm just trying to make sure everybody who has a question gets answered. There was a question about zombie companies. You just hit it and you typed it for those that didn't see. But the question is, have the zombie companies been weeded out to a certain degree? And some, right? Some, probably not. They're not all gone.
A lot have been weeded out, and the ones that still exist have been hit really hard. Like they're down a lot, and you can really see it in this chart right here. And you've heard me obsess about it. This group could get worse. I mean, this is the thing. If you own, some of you named Poland, but they're a growth manager, so you can name any growth manager. If your stock is down 20%, it sucks. Like we all hate it, right? But if it's one of the world's greatest run companies, you still sleep fairly well at night. You have companies in this quadrant, Zacc, they're never coming back, ever.
Right.
Never.
Right. So, okay, so let's tackle, I'm trying to think of organizing these in the right order, but let's talk about general economics first, because there are 2 or 3 questions that are more macro by nature. So I'm going to throw out a couple here. So with uncertainty in markets, I'm going to pass on. Well, Mark, we'll get to yours in a second. That one's not as macro. So macro, so is a lot of how the market's reacting due to the Fed's deep spending, and I'm understanding it's more due to the Fed's possibility of not spending right now, right? It's actually the opposite. A lot of us think that the Fed is just racking up crazy amounts of debt, therefore the market must be reacting poorly to that. The market actually likes it when the Fed spends and keeps rates low, and it's actually the opposite, right? They're threatening to take away a little bit of the punch bowl, and everybody's like, wait, I want more of that. Hold on, right?
Yeah. This is really, Zach, you hit the nail on the head. This is really about raising rates. I mean, we haven't seen inflation in this country in 40 years, not real inflation, not high inflation, right? And we're not used to this playbook. I mean, a lot of us were kids and we didn't care back then, right? And everybody's just nervous. How much will the Fed have to intentionally slow down the economy? And their number one way of slowing it down is jack up interest rates. And by the way, that's going to blow up a lot of zombie companies. Like, you wait till a year from now, right?
Right.
You're spot on. That the number one worry of everybody right now is the Fed will have to put the economy into a recession to control inflation. That's all this comes down to right now.
So the other question on inflation, I assume the answer, so this question is, what is the impact of government spending as a driver of inflation? Do you see the future spending of current administration will create additional economic pressure to adjust rates? I mean, we're generally talking about that right now. And yes, we're saying we are anticipating rate hikes. And I'm going to throw something out there. Tell me if we're thinking right. But the impact, there are probably long-term impacts, real impacts, and short-term market volatility involved, right? So we'll see short-term market volatility. But the government spending, give us a feel for, like, what is the long-term issue here?
You know, your last question, and I'm sorry I don't have everybody's names, but whoever asked that last question about the government spending, they are right, Zach, because when the government borrows, it's spending. I know it seems weird. The government borrows from itself from the future, turns around and puts it into the economy. Okay, so think about all the stimulus coming out of COVID. Remember PPP? All these companies just getting loans like crazy, even companies that didn't need them. Okay, the next time the government admits they did something wrong, that'll be the first time. And we now know, anybody with half a brain, that we overspent coming out of COVID. They were dropping cash out of airplanes on top of the US economy. That's why we have the inflation. It's the government's fault. So the prior answer is yes, the borrowing is the problem, but not because we have the debt. The debt isn't the problem because they borrowed zero. There's no interest on what they borrowed, right? So the debt's not the problem. It's all the helicopter money they dumped on top of the economy that then got things too hot. So our economy got too hot in 2021. Now they've got to extract some of that back out. So I think we answer both those questions kind of at once there, I'm thinking.
Well, and I was going to say too, you look at it, it's part of the concern. Interest rates can't go too crazy because the Federal Reserve basically told Congress and everybody, hey, go big. Jerome Powell basically insinuated on all policymakers, go big on this bailout, and they did, to Kurt's point, and that's why we've seen an influx of cash. This is why I'd probably be more like we've overshot the interest rate expectations, and it won't go as much, is because we've done so much debt with us running a deficit. The U.S. government has to keep writing new debt to be able to service the debt.
Yep.
Does that make sense? So to cover the interest payments on it, they've got to have new debt coming in to be able to just stay afloat. So interest rates will be hampered by that ability, or you're going to watch the Federal Reserve chairman be voted out over and over again until the president they want.
Totally.
So we have 3 kind of prediction questions. We'll all just take a stab at what we can and how we feel about it. Should someone buy a home in the next 6 months or rent until rates and home prices drop? I think you've got to be careful about making family decisions on investment factors. So you've got to be really careful of mixing those two. If you're talking about a second home, a rental property, totally different ball game. If you're talking about where your kids are going to go to school and what your family's going to be doing in the evenings, if you're safe to walk around your neighborhood, I mean, there's so many factors there that you just sometimes have to swallow a pill you don't want to swallow in terms of pricing or interest rates to ensure that your family's in the right spot. From an interest rate standpoint, there's a very real possibility that rates go up on mortgages and don't come back down to levels at 2 and 3%, and you miss out, and they could even go up further and hover higher for a longer period of time. So again, be very careful of gambling your family's lifestyle and relationships on economic conditions. If you're talking about a second house, totally different ballgame, right? But anyway, I think in general, this supply of additional homes is not going to help prices come down a lot for people. I just think it might stabilize the insanity associated with trying to actually buy a home, meaning someone who wants to buy a home may actually be able to get an offer accepted instead of getting priced out every single time. I have a close friend who tracks markets, the real estate market really closely, and we're finally seeing that offers are being accepted close to asking price instead of $50,000 and $100,000 over. So anyway, I think it may stabilize a little bit, but I wouldn't bet on it coming down a ton. The other one is, do you feel like markets will begin to grow, and will they grow to a point that they will be higher than they were last year at this time? I mean, that's flip a coin for the most part, but what do you guys say to that?
Go ahead,
Well,
Matt.
I'll go first. I was going to say, I told you I was going to tease it out. Midterm election years normally are better at the end of the year, Q4. If you go back to the 1920s, that's where the bulk of the return is had. We looked at consumer sentiment being at lows that rival the great financial crisis. I'm not one to be able to say I know, right? I joke about me being a weatherman and getting it wrong, and I'm not going to get this right, but I would bet it's higher if I had to take a chance on where it is. And it's because historically these years tend to finish strong in midterm years. And then in addition to that, I don't feel like I'm as stressed as I was in 08, 09. I don't feel like I'm as stressed as I was in March of 2020. And yet the market is pricing in it as though it is. So for those
Matt,
reasons,
I've heard the weatherman trick is to say there's a 60% chance that it'll be higher. It leaves enough room for 40% that you're wrong. If you're wrong, it's
there's
like, well, that was clearly within
there's a
possibilities.
52% chance it's going to be higher.
What's that movie with Will Ferrell where he's like 50% of the time, every time, or whatever?
I do want to touch on a lot of these other questions. I mean, we'll stick around as long as people want to, but I do think we need to spend the rest of our time, official time, on the question that Mark asks, with the uncertainty in markets right now, what generally is being done proactively to protect our portfolios. We're thinking a lot about this right now. I'm going to tell you a couple thoughts that Capita is doing, and then it'd be interesting, Kurt, to tell what you're seeing from Townsquare side. We think a lot about things like tax loss harvesting right now, which is taking advantage of the fact that a lot of assets have come down in value and booking some of those losses to help in accounts that are not IRAs and 401ks and things like that. You can do it in regular brokerage accounts, non-retirement assets. So it's a project we're about ready to kick off and work through that for our clients. We look at those one by one on every single one of those accounts and place trades and fix that and make it look good. That's not really helping a lot on the investment side. That's just helping on the tax side. It's neutral on the investment side. Oftentimes we like to rebalance. Like, for example, during COVID, bonds didn't go down nearly as much. And so we took bonds and actually bought stocks cheap. So if we find another opportunity to do that, we may. Stocks are down more than bonds, so we still probably could do some of that in a lot of the portfolios. But bonds having come down so much makes that a little bit less advantageous than normal. So it's not as much of a, I say no brainer as it, but I'll tell you what, it wasn't easy in March, April of 2020 when nobody knew what COVID was going to look like for the next 2 years to basically decide to buy stocks. But most all of our clients are thousands of dollars ahead as a result of that action. But it wasn't easy. We're looking at that again right now as well. The cost benefit on it, there's really not cost, but the benefit on it is not as big, but I imagine we'll get into that to some degree. Most of the positioning to protect a portfolio has to do with individual client situations. So you need to ensure that you have 1 to 3 years, you're spending in 1 to 3 years in ultra short-term investments that really haven't experienced much volatility at all, in spite of everything going on right now, 1 to 3 year bonds or money markets and things like that. And then you'll be fine. And then we have 3 to 7 year assets that are usually either diversified in conservative income producing things or more bonds, and they're only down 5, 10, 15% instead of 20, which all these numbers sound like a lot. It's hard. So that's organizing your wealth the right way according to your time frame. 2, within each one of those categories, that's where we rely on Townsquare and their managers to do some positioning. And so I know that Townsquare they make minor adjustments between large companies and small, value versus growth. And as those drift, they rebalance back between them. And this is maybe where, Kurt, you could step in and give us a feel for behind the scenes. What are you guys doing as well?
Let me add one comment about your idea about planning. Zacc is right on the money. You never know when a market's going to have a huge year or a terrible year. You just don't know. So planning is the starting point of everything, because you're getting the right amount of your assets in each bucket. That is the critical starting point to the process. And what you're looking at on the screen is, okay, this goes back to 1980, but if you go back to the Great Depression or 1950, the data looks the same. If you go to 29 or 1950, the US stock market is up about 11% a year on average for that window of time. And you can see here, since 1980, most years the market's been up. The problem is every single year there's some kind of drop. And sometimes the drops are awful. Look at some of these numbers. 50% drop, 34, 28, 34. Okay, so you have to have a portfolio of assets that are built knowing that every year, here's the number, you're going to have an average of a 14% drop every single year. Okay, so how do you do that? What you're really trying to do, once you've decided what the right amount of money is, and you know that big market sell-offs are going to happen from time to time, that's when you go back to what we talked about earlier with the types of assets that you need to own. So today, most everything we own is in here. We own very, very little out here. And then there was one other chart that I showed you earlier about this. Remember this? And I talked about the biggest companies had become a huge part of the S&P 500. Well, Zacc and Matt know that in the last year and a half, we were slowly flattening that out so that we didn't own as much of that group. And now in the last several weeks, we're really grateful that we made our investment portfolios more flat and not as top heavy. And that's the kind of stuff that, you know, we spend our lives in the weeds, where Matt and Zacc and his team will help create for you a larger plan so that you get the buckets filled up correctly. So
I like it. Kurt, I'll answer a couple questions, but we're done here for the most part for like the general webinar. But for those of you who have questions in there, let's just keep talking for a minute if you're okay. Okay. So let's see here. We answered that one as well. Talk to us about what do you think could happen to the market if China invades Taiwan?
Yeah, it's bad. That's a lot worse than Russia invading Ukraine. That's a bad deal.
Well, that sends ripple effects against supply chains. That's
the problem. Matt hit the nail on the head. 63% of every semiconductor chip in the world comes out of Taiwan. That's your problem. In one sentence, you want to talk about a supply chain problem. If you're going to jeopardize almost 2/3 of the global semiconductor market, I mean, all hell's going to break loose. So that's a legitimate fear. Now, what's really interesting is people a lot smarter than me are thinking that likelihood dropped a lot because Russia invaded Ukraine, because they saw the sanctions that the West hammered onto Russia. And I mean, it was a hammering. We've never seen sanctions like this. Never. Like we are pulling against Russia. And you got to remember something. 40% of every dollar of Chinese GDP comes from the United States or Europe. So if China's going to make a move, it's a suicide move. They're basically going to say, all hell's going to break loose and we don't care, because when the world stops buying from China, their own economy is going to collapse. So.
And I don't know what the probability is, but part of me looks at China, and between them battling COVID, wanting to have 0 cases, and then they're fighting internally with their large companies that are on the US stock exchanges. They've got so many fights that they're fighting internally that part of me also thinks, Kurt, you put that on top of what you just said, and it's like, I don't know if it's highly probable that they're going to go pick.
And the Chinese are a lot smarter than the Russians. The Chinese want to make money, man. I mean, that government is sophisticated in a way that Putin is not. So it's going to be a stunning development if that happens, but it is dangerous. And that's why people worry about it. And it's a great question to ask. There's no week that goes by we don't ask it around our hallway around here either, you know?
So question here, I think this is the last one. As inflation levels off, will products and goods prices level, or will we see costs of goods and products decrease? Should we be waiting for a recession to buy equities, or what is now built in make investing a go at this time? And I think this is, I know this person and he's very opportunistic in trying to take advantage of basically the markets. And if I'm reading between the lines here, there's a little bit of saying like, hey, is this our best opportunity if we were to buy? And is it a bottom? Obviously we can't call that. And, you know, and he's also maybe looking to buy some things. I know this family situation, so they have expenses on building homes and things like that. Anyway, give us a feel for like, how much is it going to cost these families to expend money, as well as if they want to invest cash, how much of that's priced in, and do we have a decent opportunity here with equities?
It's pretty clear that certain inflation is going to come back down. Look at used cars. It was a very bizarre set of circumstances, and already inventories are going way up on used car lots. So that you're going to see that come back down. It's kind of like oil. Oil can't stay at $200 a barrel, right? Because people just pull it out of the ground. Now there's a lot more oil. It has to come back down. But some of this inflation is permanent. You know, there's a lot of interesting data that shows how sticky inflation is. Most things don't go back down once they've gone up. Wages don't go back down. Rent doesn't typically go back down. So it's a little bit of both. Some of the stuff that was temporary is going to come back down, but most of it's probably pretty sticky. Zacc, I want to add one other thing, because it's the second time you brought it up, and I really wish I had the data here to show on the screen. In every single case in U.S. stock market history, the stock market has bottomed well before the recession bottomed. In every case. Now, the length of time is different. But in every case, this is why timing markets is so hard, because the bottom, you have to buy when everything looks awful. Like that's like, you know, it's like you're buying into a cascade in your face. Like it's like,
right.
You know.
When it feels awful and it's scary. And, you know, interestingly enough, for those of you who are still here, like we haven't experienced many calls. I mean, I usually hear from the other advisors, oh my gosh, I'm getting a decent number of calls. I've had 5 clients call, which is like nothing in a group of 200 households, right? But this is different right now. For as bad as things have been, we haven't had, and good for you guys, like good job, everybody, but I haven't had a single call from clients stressed out about it. I'm sure they're feeling it, but it's been in different time. I don't know what that is. And I honestly usually wait for, this is just kind of insight. I wait for a bunch of calls from clients before I try to buy, because that's usually when we're getting closer to the bottom.
But again, you have really good clients. This is the problem.
I'm a little bit confused. They're not that great of an indicator anymore.
No, but that's really true. And actually, Zacc, going back to the question you asked Matt earlier, I personally, I think we're going to end the year higher, but I think there's a really good chance we could go lower first. What my biggest disappointment right now is actually what you said. I wish there was a little more capitulation.
Right.
I have this one client that I've had for 20 years. And every time that in the 20 years that he has called me and said, get out of the stock market, that's been the bottom within days. And he hasn't called. I'm really worried that he's not calling. So
it must not be the bottom. Then.
It's not the bottom, I guess. Hey, I don't know.
That's all right. We've got a 60% chance. And anyway, Thank you everybody for joining. We're going to wrap up there. We'll get this recording up so that you can watch it. And Kurt, I assume you're okay with us sharing some slides on there as well. And so we'll make the slides downloadable there as well. We're really appreciative of everyone that spent the time with us and hope that it's been helpful to you. Thank you. Appreciate it, Kurt.
Guys. Awesome. See you guys.
This podcast is intended for informational purpose only and is not a substitute for personal advice from Capita. This is not a recommendation, offer, or solicitation to buy or sell any security. Past performance is not indicative of future results. There can be no assurance that investment objectives will be achieved. Different types of investments involve varying degrees of risk, including the loss of money invested. Therefore, it should not be assumed that future performance of any specific investment or investment strategy, including the investments or investment strategies recommended or proposed by Capita, will be profitable. Further, Capita does not provide legal or tax advice. Please consult with your legal or tax professional for advice prior to implementing any strategies discussed during this podcast. Certain of the information discussed during this podcast is based upon forward-looking statements, information, and opinions, including descriptions of anticipated market changes and expectations of future activity. Capita believes that such statements, information, and opinions are based upon reasonable estimates and assumptions. However, forward-looking statements, information, and opinions are inherently uncertain, and actual events or results may differ materially from those reflected in the forward-looking statements. Therefore, undue reliance should not be placed on such forward-looking statements, information, and opinions. Registration with the SEC does not imply a certain level of skill or training.